Hey everybody, Dale here with Terravest Capital Partners. I hope you're having a great day wherever you're at today. So, you may have recalled in several of my videos when we're talking about distressed debt or delinquent loans being sold by lenders, I do mention that they can present a really interesting opportunity for investors that are looking to get real estate exposure, but they want to be or they need to be passive in their investments. But because of the passive nature, it can also present a very interesting investment opportunity for people with self-directed IRAs, or maybe they have an IRA that they have a lot of cash in it, and they'll need to move over to a self-directed IRA to participate in that. So I do have a special guest. I have Chris Tanner. Chris with New Direction Trust, and it looks like you're in Colorado, aren't you?
Yeah, we are. So I don't know if people will be able to see my background, but
I
I've got
do.
the Rocky Mountains there. So
Yep. That was
that's my home. We're skiing and all that. You bet.
Yeah, that was my guess. Um, we're going to talk about using a self-directed IRA for real estate investing, and more specifically, as you know, I do delinquent debt and non-performing debt that is sold by lenders and hedge funds and people like that. But let's start off, first of all, who is New Direction Trust?
Yeah. So we are a self-directed IRA custodian. And so when you hear the word self-directed, what that really means is that we allow our clients to invest in things outside of the market. So things like real estate, or in your case, it could be like a note, which is an indirect way to invest in real estate. But we allow clients to invest in some alternative assets. And so that's really what we specialize in. And so we have folks, that's our bread and butter. That's what we do.
Perfect. So yeah, when we think about somebody that has an IRA, I'm assuming they could say, well, I could get a real estate exposure in an IRA, but that's probably going to be usually through something like a REIT or something like that, wouldn't it?
Yep. And so at the end of the day, with most retirement plans, it falls under the category of a publicly traded security. And so the type of things that you're doing, your Fidelities, Vanguards, those kind of companies, they're not going to allow you to invest in like an individual real estate note, as an
Right.
example, something along those lines. It's something that's kind of more of a prepackaged type investment that's technically considered a security. So,
So as an investor, you're pretty limited on what you can control. You simply buy the REIT and the REIT does what the REIT's going to do. As somebody that wants to maybe be a little bit more involved at the deal level,
mhm.
they simply could not do that out of a traditional IRA. And that's where a self-directed IRA comes into play. Would that be
Yep,
correct?
exactly. So in your situation, that's a great example. You might want to invest in ABC Main Street, where like we have a specific property, and maybe that specific note makes a lot of sense. If you're in a REIT, you're along for the ride,
Right.
right? You're not picking the properties, you're not actually picking the investment. You're just very passively investing. Whereas here, you literally could pick a specific property with a note and terms that you like.
Absolutely. So let's talk about the passive side of this because as you mentioned, right, you could say, well, I own a REIT. So yeah, I'm about as passive as I can get because I have no control over it whatsoever. They're going to buy what they're going to buy, they're going to sell what they're going to sell. I'm simply there for any particular either movement in share price or if there's dividends or something like that. But then when we talk about a passive investing as a real estate investor, kind of at that deal level,
Mhm.
um, passive takes on a new meaning, doesn't it?
Yeah, absolutely. So by passive, I think in this situation, we mean you're not dealing with tenants and toilets and things like that. You're like the bank, right? So
Yeah.
passive meaning, you're investing in paper for
Yeah.
all intents and purposes,
Yeah.
which actually is a good fit for retirement plans, uh, because there are some rules around what you can and cannot do. So passive investments actually are a good fit for retirement plans, because it keeps you away from any issues that could come up. Like, if you're buying real estate directly, you can't do work on the property. Well, this is a good example. You're not in there doing work,
No.
right?
No.
So it's, you're buying a loan
Yeah.
essentially or a note. So yeah, it's very passive, and that's a good fit for real estate plans
Yeah, and
or
really, especially
IRAs.
in the space that we're at with delinquent debt or non-performing loans, other than the evaluation of an individual loan, whether or not we want to make an offer on it to a lender, once we own that loan, we send it off to a licensed loan servicer. So the licensed loan servicer is pretty much doing everything. Once we've done our initial due diligence, we decided what we want to buy, we make the offer, the lender accepts the offer, we close on the deal. That loan now goes to a licensed loan servicer. So we're all passive in that degree. Plus, we're staying compliant from state to state, right? We're not getting involved in, debt collection or anything like
Yeah.
that. So we want to stay compliant for everybody involved, for Terravest, for our investor, for everybody that's involved. We want to remain compliant. Plus, rely on professionals, right, that do this for a living.
Yep.
So what you touched on there was what's known as self-dealing. Is that correct?
Yeah, and so just so your listeners are aware, the IRS does have some rules. So you absolutely can invest in these private notes, but I'll give you some examples, things you could not do.
Sure.
So, as an example, not that this would come up in your situation, but you cannot loan to somebody you know that's like a direct family member,
Okay.
as an example. Like your son needs a loan on a property, we can't loan to a son or a daughter, or just as an example. And then some of the other rules are that you cannot provide personal services, and we touched upon this. So if you did buy a rental, you can't live in it, or you have a property, you can't live in it, you can't do any of the physical labor that's involved in it.
You
And
can't
so
fix
that's
the
why,
toilet, and I don't know why you'd want to.
that's right. We'll hire a professional for that too, unless you happen to be a plumber. But with retirement funds, it's just people do need to know there are some rules in place. And so an investment like this, where it's being handled by somebody else,
Yeah.
and I just can't imagine the odds that you're going to buy your own delinquent note. I just don't think that's even going to be an issue. But
I've
anyway,
heard people try and suggest that. And no. Yeah.
yeah. But otherwise, when we connected and began talking, everything you were telling me about how you handle those investments, I was like, all I saw were green lights from the standpoint of I don't see where there'd be any issues with the IRS. So this would be a pretty conservative way to invest it just in terms of following the rules and guidelines with the IRS.
Perfect. Perfect. Yeah. So one reason I typically post content on LinkedIn is because I'm trying to reach the more sophisticated investor, the working professional, somebody like that. And that audience that I'm trying to reach, they're busy professionals, right? They've got a
Yeah.
career. Maybe they do have a rollover IRA from a previous employer or something like that. But at the end of the day, they're a working professional. They've got a career, and I've met professionals, people that say, "Well, I want to get into real estate," and then they give up time that from their profession to learn how to become a wholesaler or how to do fix and flips or rehabs or what have you. And sometimes that can be a horrible investment in time if you're taking time away from your profession where you're making good money, trying to go learn how to be a wholesaler or something like that, which we know the success rate of wholesalers, the number of people that are successful at it versus the number of people that try it. But, all those TV shows on A&E and what have you convince everybody that they can go out and rehab a house. But yeah, so I try and position that this can be a good opportunity for those types of investors. But let's suppose it is somebody that, yeah, I've got a rollover IRA and I've got $100,000, $200,000 in this rollover IRA. What do I need to do to move that from that IRA over into a self-directed IRA? And that's where you guys come in during that process.
Yeah, exactly. So the first thing is I always identify this as three steps. Step one is creating an account, which is super easy. You just go online and you open an account, and we're just going to want to match the account to where the money is coming from. So if you have a tax deferred account, like an old 401k, we're going to open up a traditional IRA. So it has the same tax status. If you happen to have a Roth account, we're going to need a Roth account to accept those funds. Step two is getting the money moved. We're very good at that. What we will do is we'll either help transfer or roll over the money. We want to do it in a way to make sure that it's not being taxed, no
Okay.
early withdrawal penalties. So almost always move it directly from one custodian to another. And then the final step is where you come in, and that is where we're going to look at the investment itself. And so when we're looking at the investment, some important things to keep in mind is we want to make sure it's the IRA that's the investor.
Hmm.
It's not the individual. Now we help with that, right? We're not going to fund an investment. We look over the paperwork to make sure that that is the case. Uh, and then you just direct us, or the client directs us to go ahead and fund the investment. We'll wire funds, send a check, however we want to get that investment created. We'll go ahead and send those funds over.
Perfect. Yeah, so that's where I wanted to, and if I misspeak, please correct me on this, but whereas somebody they might have an a retirement account of some sort. And yes, somebody is responsible for managing that retirement account. But in this situation, you as a custodian as at a self-directed IRA and at New Direction Trust, you're going to be more helpful to that investor versus they got to go figure everything out for themselves. Would that be correct?
Yeah, absolutely. So that's part of our job as a custodian, is to kind of help the client walk through all those steps. And so when somebody opens an account with us, they're assigned to, we call them a new account manager. So they have a single point of contact. That individual helps get the money moved over, helps with the investment paperwork. And then we have an underwriting that goes on. So when paperwork comes in, we have transaction specialists. They'll review everything,
Hmm.
and we won't fund an investment. Like if it's titled in the name of the individual, we won't send the money. We'll make sure it gets corrected before we send that money out. So we are definitely looking out for the client's interest because we want to protect the tax treatment. Imagine if you have a Roth IRA, this is tax-free income to a client, potentially. We want to make sure it stays tax-free. So we'll make sure, any interest that's reported, we'll assign an EIN number for tax purposes to
Okay.
make sure that we protect the status of that account.
So it's interesting, and that is news to me, or something that I'm appreciating is that not only, you know, we get a loan tape from a lender, could be several hundred loans on it, identify those properties that look like there's an opportunity, uh, make the initial bid, the lender accepts the bid. That begins our due diligence period where I would go through and we would go through all the information about that loan that that lender has, servicing history, communications, everything. And so we're doing our due diligence, but at the same time, your clients can feel comfortable that not only is it going to be our due diligence, but you're going to have a due diligence function as well in this process.
Yep. And just to be clear, our due diligence has nothing to do with the actual investment as far
Okay.
as like what you were saying.
Whether it's investment worthy.
Yeah. Yeah. We
Yeah,
don't we don't evaluate it for that.
right.
We are primarily just protecting the titling of the investment. We want to make sure the IRA is the investor, and protecting the tax status of whether it's tax deferred or tax free. And we do that by assigning an EIN number. And I'm assuming if interest is being paid, there's some kind of reporting
Yep.
that goes on, that when you're collecting interest, there might be like a 1099 or something that gets issued. We'll definitely make sure that it's reported to a number that's associated with an IRA plan and not like social security number as an example.
Perfect, perfect. So you touched on the process of moving from an IRA over to a self-directed IRA. We touched on the process of what would it look like if you have a client that wanted to work with Terravest on some of this delinquent debt. So, now somebody's calling me and I got to ignore them. Software.
Yeah.
That's fine. That's fine. Yeah, we're actually doing pretty good. It looks like we have some time. So at New Direction, and we kind of kept it specific to what I'm doing here at Terravest, but
Mhm.
there's a lot of things that somebody can do out of a self-directed IRA when it comes to real estate. And also there's a lot of services that you can provide. So are there anything that you want to touch on that once somebody's working with you that is available to them that may not have been available in traditional IRA or what they're used to?
Sure. Uh, the biggest thing that I like to try to get the bigger picture item is that with these types of accounts, you really open up a lot of possibilities in terms of what you can invest in. So a lot of times people come in with the misconception that I could, like, if they just happen to know, oh, I can invest in these notes with Terravest, that's like the only thing they can invest in, and that's not true. So people can still invest in securities like stocks, bonds, mutual funds, but they can invest in real estate directly. They can buy rental properties,
Okay.
they can invest in precious metals. Uh, this is basically private lending. So all of those things are open and available. And so could be private equity as well. So there's just a lot of options. What this does is it opens them up to more opportunities, not less, so to speak.
Absolutely. And I think, one thing that we see with the sophisticated investors, they know about alternative assets and where things are because oftentimes, and we can thank YouTube for this, but when people start researching, how do I become a real estate investor? They're often given, well, here's your path. You become a wholesaler, then you start doing fix and flips, then you become a buy and hold landlord, and maybe someday you move into a multifamily,
Yep.
right?
Yep.
That's the
Yep.
path. But one thing
That's
I
right.
try and teach people is that there's so many different paths. And even for people, many real estate investors, they struggle with getting funding. And I'll do bridge lending and what have you for rehabbers that I know. And I work
Mhm.
with hard money lenders that I know because I trust their judgment on projects. But there are many paths to real estate investing. Can you use a self-directed IRA as a private lender on rehabs and things like that?
Yeah, absolutely. I've done it myself. Uh, and you're right. When you say the word real estate, there's about 20 ways to get into real estate, but that's absolutely one of them is private lending. So I've done that myself, where kind of in the examples you've given, you might be lending to a fix and flipper
Hmm.
as an example. They're buying a property, they fix it up, and so you're kind of serving as the hard money lender, or it could be really any variety. So you could do loans, long-term loans to investors. There's really no limitations from the IRS standpoint other than who you're lending to and who you're investing with. And so we want to be careful of investing with personal deals and be
Hmm.
careful with investing in what I would call, your blood related kind of family, mom, dad,
Yeah.
your sons, daughters, grandsons, granddaughters, those kinds of people. But otherwise, pretty open when it comes to the types of investments.
I think it's just generally good advice. Don't go in business with family.
As a general rule, I think I would agree.
You know what?
Yeah.
Yeah, I mean, sometimes it might work, and congratulations if it does, but um, that becomes a tough one. So,
Yeah.
yeah, the way I normally state it, depending on, if we're in our buy box and we're buying a residential loan that's moderately delinquent, our first objective is going to try and get that borrower reperforming, starting making their monthly payments again. Put them in a 12-month reinstatement plan. We don't modify the loan. We simply reinstate it. We keep the foreclosure in place, right? The lender
Yep.
has usually started the foreclosure. We want to keep the foreclosure in place. Somebody said, well, why do you want to do that? You want to keep this might sound terrible. Say, well, you want to keep their foot on their neck. And I said, well, yeah, I want to keep our foot on their neck to put some pressure. Once we
Yeah.
modify it, we lose, if something happens, we have to start that foreclosure all over again. So we keep the
Yep.
foreclosure in place, work through a licensed loan servicer to try and reinstate the borrower. After 12 months of on-time payments, now we have a reperforming loan. We bought it at a steep discount because it was non-performing, but now we have a performing loan, what's called an RPL. We can exit then that we can now exit that loan by selling it to another note investor that simply wants passive yield. And we arbitrage the difference. We rehabbed the loan. We didn't rehab the property. We
Yep.
rehabbed the loan. If that doesn't work, we always have things like deed in lieu, cash for keys, and we can even approve a loan assumption if somebody wants to come in and assume that loan and begin making
Yep.
those monthly payments. So we can hold for yield there, or we can exit. Um, Once suppose we do cash for keys or deed in lieu, now we're sitting on this property. We can exit because we're typically buying at 50% or less of fair market value. So we've got equity built into it. We can sell it, exit then, make everybody whole. And then the last part is if that doesn't work, because we kept the foreclosure in place, we can complete the foreclosure. Because we bought at a discount to the legal balance, we have some margin in there. If it sells at auction, we walk away with the profit. So a lot of different strategies we have available to us. And I tell people that you're looking at, it's going to depend on the state and what have you, because every state has different foreclosure laws, redemption laws, and all of that. But expect anywhere from a 12 to 36-month hold time on this investment. So that brings me to my next question, because we still have time. Suppose we get to the end of investment. How do you close an investment?
Yeah, very straightforward. It's kind of similar to how you get into the investment. You literally just let us know that the investment has come to an end, and we just have a form that they complete online. We call it a sell form, which makes sense. You're either buying or selling.
Okay.
Usually, this will accompany money coming back into the account, and it's just the way to notify us that the investment has come to a close. And
Okay.
so we don't always know because you might be getting payments that are ongoing. But to your point, maybe at some point somebody buys the loan and now that particular note or that investment comes to an end. You just let us know. Once the money is back in the account, the client has options. So similar to how you have a lot of options with this note, how you can work that note to try and make a profit. Uh, the client can reinvest, keep going with a similar investment. They can move the money back to their financial advisor, wherever they happen to be, or they might find another alternative investment. But the accounts that we offer are self-directed. That self-directed means that the IRA owner has the choice. So
Perfect.
once the funds are back in there, up to them.
Well, my hope is once they do one or two deals with us, they won't want to leave and they'll just keep on looking. They'll be sending me an email saying, well, when are we going to see more delinquent loans coming in from the lenders? And I promise you folks, they're coming. I'm definitely seeing them.
Yep.
It's just a matter of what states do you want to buy in?
Yep.
So there's always an opportunity somewhere. And that's why, like on my investor interest form, I do ask, are there any particular parts of the country that you're interested in? Chris is in Colorado. I'm here in Minneapolis, even though I look like I'm dressed. I dress like I live in Colorado today, apparently, but or Alaska or something like
Yeah.
that. But I was on a call this morning with an investor, and even though they're here in Minnesota, they're active on the West Coast, and they wanted to talk about the multifamilies that I have available out on the West Coast, like in the north of San Jose. So
Hmm.
investors could be interested anywhere. And here's the thing I will say too is that unlike fix and flip and rehab and what have you, where you kind of, yeah, I know some people that do fix and flip cross country. I don't know how they do it. I've met them, right? They
Right.
live in Seattle and they're doing fix and flips in Nashville. I don't know how they're doing it. And that would freak me out. But with this, you can be anywhere and
Yeah.
invest, right? So a lot of
Yeah.
flexibility, and again, geared towards that passive investor and says, I want real estate exposure. I want the better than, better returns than what the market is giving me. Or if you're just sitting with idle cash, certainly better returns than that. And take advantage of that flexibility. So, Chris, we did good on time today. We actually got about 15 minutes left. Any closing thoughts or anything?
Yeah, a couple things I did want to mention. So this question comes up quite a bit.
Please.
Uh, Most accounts that people will have that are in the retirement account realm, we're able to take those funds, move them over, and invest in these types of alternative assets. It's important for people to know they can do partial rollovers or partial
Okay.
transfers. And the reason I bring this up is it's not uncommon for our clients to get into an alternative investment. Maybe they're kind of dipping their toe, just as an example, and they say, Dale, maybe I'll try one of these just to kind of see how it goes. And then to your point, well, then the deal ends. Now the money's back in there. These accounts are flexible from the standpoint of you might very well have more money in this IRA over here with this other custodian. You're free to move more money in and, continue with that investment, if that makes sense. So if you like the way it's going, there's no limits on how much, or you have flexibility is the big point there.
Okay, that's a good point because I know like the new IRS rules for 2025 just came out when it came to contributions to, is it a
Mhm.
401k or something like that? So how does that work for a self-directed IRA? Do you have limitations or how does that work?
Yeah. So there's two categories there. So it's important to know. So what you're talking about are contributions where we're adding
Right.
new money
Yeah.
into the account. The accounts that we have follow the exact same rules as that the IRS has for any other IRA or 401k. So as an example, traditional Roth IRAs, you can put in 7,000 if you're younger than 50. You can put in up to 8,000 if you're older than 50. Those rules don't change with us. The underlying account is the same.
Okay.
Uh, so there's same exact rules basically.
Okay. All right. So it really is based on that initial move of funds from a traditional IRA over to that self-directed IRA, kind of get you going
Yeah,
because with a limit of under $8,000 a year, that's going to be, I always tell people you need to have at least 50,000 really to participate in these types of things, right? You don't
yeah,
want to get into the low balance loans and what have you, because once you get into a low balance loan or a small loan, that means the monthly P&I payment that the borrower is making was small to begin with. Once we pay a loan servicer, we start giving up profit pretty quickly. So yeah, you should probably have at least 50,000 in the self-directed IRA in order to participate in this type of passive investing. So I just got the
yeah,
10-minute warning, and like I said, we did good. Um, and I appreciate your time today. If anybody's got any, what I'll also do is I'll put your contact information on the video. When I do the edit, I'll put
yeah,
your contact information on the video. But also, I would say is I'll also, through my LinkedIn, reach out to me. I'll connect you with Chris. And I'm not compensated for this in any way, Chris, right? I'm not an agent
that's
of
right. That's
New
right.
Direction. I'm simply trying to share resources with you because I can hear the thought bubbles or I can see the thought bubbles when people watch the video saying, well, this sounds complicated. And people are maybe they're uncomfortable with the financial side of things. And they said, well, this sounds too hard. I'm not even going to try it. But it sounds like you guys can make it easy for them. You're going to guide them through that process. And I think uh, they'll be very glad that they made that decision, especially if they're sitting on idle cash.
Yeah, absolutely. And it's not uncommon. Like I said, we have people, they'll move some money over, make an investment, they'll kind of get a feel for how it works. And it is a little different to begin with. This isn't your financial advisor picking all your investments for you. You're coming in, you're telling us what you want to invest in, and we're just allowing that to happen. But yeah, we're set up. We've been doing this for 20 plus years, so we understand when somebody comes in and they're new, we know exactly right what kind of assistance they're going to need. So we're used to working with folks that are kind of new and maybe a little bit leery of how this process works. So happy to help them and we appreciate you sharing our contact information. And really, it's just a matter of reaching out and understanding, how it works. We can kind of decide if it makes sense for an individual, and I'm more than happy to answer those questions.
That sounds great because I think at the end of the day, we can all agree that freedom of choice is something we all like to have, and that should apply to our investments too. Vanguard, I think, did a study and they realized I think like 47% of the people that had an IRA with them did not realize that once they made a contribution, the money just sat there in cash. It would have to go somewhere. So,
That's right.
so yeah, I mean, there is the burden of decisions in a situation like this. But again, if it's somebody that wants to be involved as a real estate investor and at the deal level, that comes with the responsibility of
Yeah.
making those decisions. Chris and New Direction are there to help you with this, but you are committing to your retirement. Now, your returns, I think, could be much higher. by doing this for sure. But yeah, I appreciate your time today, Chris. And I will stay in contact with you, and you have a great weekend. And thank you, everybody, for joining us today.
Thank you so much. You do the same.
Take
Appreciate it.
care.